Carvana's stock price is up 200%, over 200% so far year to date in 2023. Is that rise justified, or is that just overexcitement over Carvana stock? I'm going to answer that question in this video looking at 4 different metrics, so let's get right into it. The first metric I wanted to highlight is Carvana's tremendous revenue growth during the pandemic. You see here I have the chart going back to before 2019. This is Carvana's trailing 12-month revenue, TTM. And looking at 2019 to 2020, yes, the company was growing. But if you look at after 2020, between 2020 and a few quarters ago, you have revenue growth jumping from 4 billion TTM all the way up to 14.52 billion, a more than tripling of TTM revenue as a result of explosive growth during the pandemic. Its business model was tailor-made to capitalize on the circumstances that arrived during the pandemic, the supply chain shortages for new cars, the stimulus checks for consumers, the fact that consumers didn't want to go inside a car dealership to negotiate and talk with salesmen and test drive, and they just wanted the cars to be able to buy the cars online or through the vending machines that Carvana has without needing to necessarily interact with salesmen and dealerships and all of that. So everything just kind of worked in its favor during the earlier stages of the pandemic, but those benefits are now retreating. You could see here TTM revenue has it peaked and now it's coming down, and it's going to continue to come down over the next few quarters as the supply chain constraints for new cars have eased, and then that's causing used car prices to really come down, and that's a further headwind for Carvana because it bought these used cars at elevated prices and now it's needing to sell them at the new lower prices, and it's unlikely that used car prices will even stay at where they are now. Even though they've come down a little bit, it's likely that there's further room to come down because prices are way above where they were before the outbreak, with no real reason why they need to be this high, especially for used cars. The next thing I wanted to show you is the operating profit margin for Carvana over the trailing 12 months. What you see is, again, because of the pandemic and the surge in sales, it was increasing its operating margin, but still negative, even though they had pretty much the best circumstances they could have hoped for during the pandemic. Still, they were operating at a negative operating profit margin. And of course, as sales have peaked and have started to come down, its operating profit margin is collapsing back down to negative 7.95%, right around where it was before the whole peak boom cycle it experienced. The next thing I wanted to look at was the cash flow from operations, and what we notice here is another collapse, falling cash flow from operations, TTM, all the way in the negative. In the most recent trailing 12 months, negative $1.757 billion of cash outflow from operations. This is money that the company is paying for its expenses, but also money that it's paying for its car inventory. And now it's getting stuck with the inventory longer than it's used to because sales have slowed down. And this is extremely troubling if you consider that Carvana only has 316 million in cash and equivalents as of its latest update. So it's burning through $1.757 billion over the last 12 months. So that's a little over, let's say, 125 million, 140 million dollars per month, and it only has 316 million dollars in cash. And so it's really getting close to the moment where it's going to need to take drastic measures to increase its liquidity. Otherwise, it's going to run out of money. So that could mean going out into the markets and trying to borrow more money through debt. And this isn't exactly the best time to do that because expenses are soaring. Or it could sell its stock, which that's a new lifeline that it actually got now that the stock increased by 200%. So that's a real solution that it can employ, or it can start to really sell the cars it has in its inventory at much lower prices, just because it needs to get rid to turn some of that inventory into cash. So out of those three options, I think the best one is to sell more of its stock, especially now that the price has soared by 200% already in a little more than a month. So let's look at its valuation now. Even after the 200% increase, the stock is still trading way below its premium valuation. It was once trading at a forward price to sales ratio over 2.4. It's now just 0.112 in terms of forward price to sales ratio. Still, even though this is trading at a significant discount from its peak valuation, I wouldn't say the stock is cheap, because the company is not profitable. It's burning through cash, it's facing liquidity problems, and it's really facing significant headwinds from the overall business model, because it has yet to prove that this business can work through peak and trough cycles. So to answer the question, is this 200% boost in the stock price justified? I'm going to say no. I didn't see any reason why the stock should have increased by 200%, considering all of the macroeconomic circumstances and the difficult liquidity situation the company is in. So that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.